So how can a company with millions of die-hard fans, a super slick brand, and massive growth still be losing a ton of money? Well, that's the core puzzle of CRED, the fintech darling that's now at a major crossroads. Let's get into it. All right, let's start with the big headline from fiscal year 2024. The numbers come in and wow, revenue has shot up to nearly 2,500 crore rupees. On the surface, that looks like a huge victory, right? But then you see the other number, the one that tells a different story. A net loss of over 1,600 crore rupees. And here's the real kicker. That loss is actually bigger than it was the year before. Ouch.
And of course, the market noticed. In June 2025, investors sent a very clear signal. CRED's valuation got a reset down to around $3.5 billion. Look, that's not just a number changing on a spreadsheet. That is a wake-up call. It's the market saying, the clock is ticking. You need to show us how all this trust you've built actually turns into profit.
Okay, so to really understand this tension, we have to go back to the very beginning. CRED's original idea was so clean, so simple, it was a members-only club, a velvet rope for the financially savvy.
It was never just another payments app. No, this was about getting an invitation. It was about joining a community built around a single, powerful idea, being responsible with your money. It was about status. And that gate is everything, seriously. By setting the bar at a 750-plus credit score, CRED wasn't just filtering users, it was building its core asset. The user base itself, this premium cohort of India's most creditworthy people, became the product that brands and lenders would eventually want access to. So CRED has this amazing, hand-picked audience. The logical next move? Start layering on more services to figure out how to monetize them. And that's exactly what they did, adding feature after feature. But here's where they hit a structural wall in the Indian market. The dominant payment method, UPI, is phenomenal for users and for adoption, but it's largely a zero-fee world for merchants. That makes it incredibly difficult to build a business model on payment fees alone. It's a classic dilemma, high volume, but very low direct monetization. And this chart right here, this visualizes the entire problem perfectly. Look at the revenue growth from fiscal 23 to 24. It's fantastic, a huge jump. But then look at the net loss. It didn't shrink, it actually got wider. That's the paradox that puts investors on edge.
So, with monetization being so tough, what did CRED do? They doubled down on execution. They just kept building, transforming the app from a simple tool into a whole financial ecosystem for their members.
The speed is pretty incredible when you lay it out like this. They start in 2018 with just credit card payments. Then, boom, they add community investing with Mint. Then scan and pay. Then CRED Garage for your car. And then they acquire Kuvera to bolt on wealth management. They're relentlessly layering on more and more value.
Okay, so CRED is executing like mad. They're growing, they're building, the brand is incredibly strong. But, and with a market there's always a but, what did all this activity actually mean for the business itself? The market signal wasn't just a quiet suggestion. It was basically a deadline. All that growth, all that brand love, it's great, but it has an expiration date if the path to profitability isn't clear. The message was simple. Show us the sustainable economics. And that's when the reality check arrived. In mid-2025, reports of that down round came out. Now, a down round isn't just about a lower valuation. It's a forcing function. It forces a company to take a hard, honest look in the mirror and figure out which parts of the business are truly viable. This brings us to the big decision, the whiteboard in the conference room. To solve this puzzle, CRED essentially has 3 distinct paths they can take to finally turn all that trust into real sustainable profit. So path 1 is to double down on what made them CRED in the first place, go deeper into credit and rewards. Path 2 is to go to war at the checkout counter, becoming a real payments player. And path 3 is to expand into totally new areas with higher margins like travel or insurance.
Let's zoom in on that second path for a second, win the checkout. For this to work, CRED has to understand it's not really in the payments business, it's in the measurement business. You have to be able to walk into a merchant and prove with data that CRED users spend more or convert better. And this table shows you exactly how that math could work. Now, super important, these are just illustrative assumptions, not reported company figures. But the logic is what matters. If CRED can prove they drive a 10% uplift in average order value, suddenly that generates real incremental profit for the merchant. And that is the value that a merchant would be willing to pay CRED for.
So, after digging through CRED's entire journey, what are the big lessons here? What can any founder or builder take away from this high-stakes story?
All right, 3 big ones. First, your real competitive advantage, your moat, isn't the commodity layer, like payments. It's the curated community you build. Second, brand love and user growth are amazing, but they are not a business model. They have a deadline. And third, and this is maybe the most important, monetization is a measurement problem. You have to prove you create value before you can ask to capture a piece of it.
Okay, so now we're turning it over to you. You've seen the data, you understand the dilemma. If you were sitting in that CEO chair, what call would you make?
And it is a tough call with real trade-offs. Path A gives you focus, but maybe slower growth. Path B offers incredible scale, but it's super complex to execute. And Path C offers those juicy high margins, but you risk diluting the brand and losing what made you special.
So that's the final question we'll leave you with. Which path would you choose? And maybe even more important, what is the one single metric you would obsess over for the next 12 months to know if you made the right bet?